Good morning, everyone. Welcome to Wednesday and welcome to a CPI inflation report publication day from the powers that be that come down and tell us how much our life costs. Just kidding. Welcome. This morning we're talking about different people sort of chomping at the bit to open a Bitcoin ETF. Some of you might be confused. There are publicly traded vehicles that have exposure to Bitcoin, but they all have wonky structures such as trusts or futures trading for the commodity. I know that exists in the Chicago Mercantile Exchange is my understanding, but nothing is out there that lets you trade one-to-one on par with BTC in the traditional finance markets. If a lot of that was just jargon and nonsense, bear with me. We'll touch on that at the very end, actually. And then we're also going to talk a little bit about a trend I've been noticing. Private services, high cost, high convenience, especially in kind of coastal urban cities. But it's also, I think, something that we're going to start to see in more rural areas as well as prices continue to go up. So with that brief intro, I'm going to actually start with the CPI data, and I'm going to take us to Twitter. And we're going to go on to Zero Hedge. And for those of you that care, that want the latest and greatest kind of macro data, Zero Hedge is really fast at providing the inflation numbers and the CPI numbers, any like headline kind of government or agency data publication. Zero Hedge, which is a little bit of a thorn in the side of everyone in the financial world and the financial press. Because they're a little edgy, they post some weird conspiracy stuff. Their icon on Twitter here is Tyler Durden from Fight Club. It's a thing. But they beat everyone to the CPI data. So let's look at this. So CPI is the way that the government and then of course every investor in the US and the world looks at CPI. But many people criticize it because it's not necessarily an accurate exhibition of what the cost of a typical American life, a typical American kind of like basket of expenses looks like. There's a whole universe of new things that we spend our money on. Subscription services, certain memberships, donation services. Now you can online gamble. There's a whole slew of new verticals and categories that people allocate their funds to. But CPI is still very useful. It allows us to understand kind of in the big picture what's going on. So let's look at the top five individual contributors to the US CPI year over year here on the right side. So as you can see, kind of the largest contributor is rents. For the most part, for a certain period of time, it was energy. We saw here between January of 21 through to July of 22 that energy took up a massive component of people's wallets, especially on a yearly basis, year-over-year basis. We saw cost of energy increase dramatically. Rents also taking up that major component, and then the remaining contribution. And these are the shadow things that we're talking about. CPI doesn't necessarily take all of those into account. So it's been really interesting to see what categories sort of like go up and down. If we go to core CPI, which excludes energy, excludes food, just looks at some of the more core factors, we see that remaining contribution again, biggest basket, or one of the biggest baskets, but rents really dominating that segment. And then oddly we see motor vehicle insurance and used cars and trucks. I really remember this. I really remember this spike back in 2020 through 21 when new cars were not really an option. They didn't have the supply. The supply chain wasn't working properly. There was too much demand, pent-up demand. And that's been a justification for the strength in the U.S. economy throughout, almost looking at 2 years of pretty harsh inflation. And I do remember that used car section really popping up, and then you see that kind of lagging, balancing out when the new cars hit the economy. You see that the used car ownership of kind of like CPI and inflation really cooled off because the supply chain relaxed. So this is a lot. I recognize that. Take a look at it. We'll share it in the Discord. But it's just a really comprehensive way of understanding like where are your expenses increasing or decreasing, and then it's always not fun. It's not fun. But you can tie this back to your own expenses, and in many cases you'll see those year-over-year changes in prices directly apply. So we'll have fun with that chart later. Let's get off Twitter and back to business here. So the most recent report said that that inflation in the U.S. actually went down all the way to 3% for the month of June. Now, for the whole year, we've been hearing, especially when the reports come out, we've been hearing 6%, 7%, over 8% at its worst. Now the cool-off is at 3%. Something is working, right? And it's both good and a little bit worrisome. This year, U.S. stocks have rallied, especially the NASDAQ in particular, over 30%. If you're in the S&P, you're in the mid-20s or low 20s. So the market, the asset market is doing spectacularly. U.S. companies are doing fantastic. The U.S. consumer is out there spending, a lot of it pent-up COVID demand spending, and a lot of it kind of lifestyle maintenance. An interesting thing I've seen as a trend this year has been credit usage going up, savings rates going down, and many people pointing at that as how Americans have been buoying this high inflation year over year. But we've just seen incredible resilience, and that's been something that has been, the Federal Reserve has pounded the table on that. The administration, the executive branch has been pounding the table on that, on how the economy is strong, the economy is growing. The labor market remains super strong in the States. We're seeing wages increasing, not necessarily good for inflation, but it shows that the economy is resilient. Now, where I feel a lot better about all of this is the fact that we've had high inflation approaching double-digit inflations, and in some categories it certainly has been double digits, but we haven't entered the death spiral, and the economy hasn't corrected aggressively, meaning consumer spending down, employment down, productivity for U.S. corporations down. We haven't seen that. Now, if you see that and you see prices still going up and you see kind of that nervousness, it's a dangerous recipe. It's a recipe for a situation like you see in Argentina and Venezuela and Zimbabwe and Turkey as well, in these kind of hyperinflationary, sort of off-the-rails economies where inflation has really been their widowmaker. And historically, it is one of the great widowmakers. So it's nice that we went through a plague. Now we're getting through inflationary scare of a couple of years long. So it's good to see the inflation cooling down. Now, what concerns me is, does that mean that the economy is retracting? Does that mean that the employment market's going to get spookier? Does that mean that the U.S. consumer is going to tighten their belt? Are we going to see bad earnings reports? And this is why... Oh, I have it right here. This is why, to some extent, I really struggle to take my bearish cap off, because if the Fed's plan works, right, we're going to see a little bit of a pullback in terms of economic strength and economic activity. Now, is it worth it? Yes, it is unbelievably worth it. That's what the Fed planned on doing. That's why they raised interest rates so high. That's why mortgages are so high, because they want to disincentivize the demand side so that the supply side has to ease prices and bring things back to reality. So if it works, it hurts. If it hurts, it works. In some respect. And so that's why I'm a little nervous. It's been a gangbusters year for U.S. stocks, and if inflation does end up cooling off and cooling down, they may have to come back from the sun, because otherwise they'll fly too close to the sun, and it's likely that we see a 10% correction or something, really dependent on what the economic outlook is of both from the big picture, macroeconomic, GDP growth, economic activity, all the way down to what is the particular company doing. Now, this is slowly taking me to Bitcoin, and basically what we see is, if inflation cools down to the target rate, which the Federal Reserve wants inflation in the U.S. at 2% per year, they're comfortable with that, they're happy with that, and that's been the case even when interest rates were at zero. But if we do see inflation cool on the other side, it'll be because of some retraction in economic activity. It just will be. Firms aren't just going to like lower prices and end up selling more and more and the demand going up. It is just not how it works. But if the Fed then responds to inflation cooling by cutting rates, it's an absolute, nitrous oxide canister for stocks that are sensitive to interest rate changes. So in particular, technology companies, anything that has the word AI even hinting around it, any sort of highly user-oriented, growth-oriented business will react extremely positively to interest rate cuts. And I think that's why we've seen, continued positive performance over the last month, because there was an interest rate pause. The Fed identifying, hey, inflation's cooling, our plan's working. Let's not keep putting the pressure on the money markets, on mortgages, on individuals paying credit cards. Let's kind of like take a pause. So this aligns fairly well with my overall outlook. Still very bullish on the U.S., still very confident in the economic strength, very confident in Jerome Powell and the Federal Reserve. I like to joke around that like this is Jerome Powell's America. He's been Fed chair for some time now. He's gotten us through Trump presidency, transition, Biden, recession, inflation, conflicts with China, COVID. And somehow the economy has not collapsed. So, hats off to Chair Powell there, and we'll continue to see how the market reacts. And so, jump into the other stuff. I'm going a little long. BTC ETF story. A lot of people have tried to list it. Difficult to do. Regulators at the SEC are just giving blockchain and blockchain adjacent businesses an extremely hard time. They have not clearly defined what is or what is not a security in the blockchain universe. They've permitted companies to go public after deep regulatory review, e.g. Coinbase, right? And now they're suing the very companies that they gave sign off to operate in the market in the way that they, illustrated in going public and putting all their documents forth and going through regulatory exercises and whatnot. So it's a very confusing time for that space. The rule makers are sort of changing the rules as they go without providing any sort of framework for operators in the business to follow. And it's been a massive contentious ride. The first people to try to provide a public vehicle for Bitcoin in the market was Grayscale. They have the Grayscale Bitcoin Trust. It is not an ETF. You buy into it, but you have no access to the underlying Bitcoin, and you have to buy in at a premium and sell at a discount in most cases. And they're sort of an ARC. They're designed as an ARC where you buy into Bitcoin and then hopefully the regulatory agencies will say, hey, you can convert this trust into an ETF, which means you can buy and sell on the same day, exposure to the asset at the price that it's worth, at the net asset value of the fund and the underlying things. Today, the trust sells at a premium, sells at a discount, buys at a premium. And so no one's been approved. Grayscale has been applying multiple times, lawsuits, letters, opinions, law firms. BlackRock is applying for one. That's the hopeful because they have kind of that insider relationship with Washington, D.C. at the moment. It used to be Goldman Sachs. Now it's BlackRock. And there's a bevy of other fund managers, ETF houses that are trying to get a spot Bitcoin ETF approved. I mean, it'll be a fantastic business move. People will buy the ETF like crazy, including institutions that want exposure to the asset. And especially if you own the Grayscale Trust, right? If they get approved to convert the trust into an ETF, something that you may have purchased actually for a 50% discount to the actual asset could overnight, as they approve that, close that discount gap, and you actually generate a massive return. Not a recommendation of mine. It's a very, very aggressive play. I've talked to a couple of hedge fund guys and a few crypto fund guys that's their move. That's their thesis. Extremely high risk. You're looking at like a regulatory arbitrage. You have to be in the weeds with these lawsuits and regulatory updates and any changes, and you have to watch the market and know who's sort of buying or selling and link that. It's a whole full-time job to try to execute that trade. So I would not recommend you explore, but recommend you kind of look into the difference between the different Bitcoin vehicles that are out there. And last but not least, private services. I know I've gone too long. We'll go for one more minute. But this is a trend I'm noticing. We're at very kind of early stages of the mosaic process. This is really more anecdotal than anything. But it has a link to inflation and some of the other things we talked about today, which is as wealth division increases, right? And with pressure on prices, there tends to be more consumer stickiness on the high end and luxury than some of the like middle of the road type products and services. Why does that happen? Well, because wealthy people buy high end and luxury. In many cases, there's more value there long term, and you start to see also an increase in maybe low prices, low cost solutions, cheaper services, bulk products, that type of thing, and you see kind of the middle of the curve start to whittle as price pressure gets deeper, as wealth division gets stronger. And this is something that is very clear in third world countries, Southeast Asia, Latin America, parts of Africa, etc., where you see that almost anything is available for very wealthy people at very high prices. And because that's the case, there are fewer of them. The prices are prohibitively high, but the service is also incredibly exclusive. The simple example I'm thinking of is like salon services. Typically, people will go in the States to a large salon, get their hair done, get their nails done, get whatever it is that they need, but in a group setting. And you go to the store, there's 20 people inside getting treated at the same time. Whereas if you go to Brazil or Peru or Singapore, there's many cases where the salon employee will come over to your home and provide the service on a one-on-one P2P level in the comfort of your home at a much higher price, probably not higher relative to the US, but at a higher price than it would be in a group setting or a salon. And so this is something I'm noticing. I think it's a phenomenon that comes with inflation, that comes with wealth division. And so I want to keep an eye out for that. I've heard, I've talked about this with a few friends, and I've heard some crazy examples that have come up lately. Fixers in cities like Los Angeles and New York City. I've heard a lot about that kind of stuff. Of course, the hair care and salon type care are examples that I've heard. There are now sort of Uber app style services where you can order people to your home, etc. And I know that's been around for a while, but I think it is certainly picking up in popularity. This is a symptom of not great things in the economy, but I think it'll be something that, at least in the meantime, if things aren't so bad, will be pretty celebrated. It could help increase the profitability and earnings profiles of some of these people in these industries that can cater to individuals. Could be a great way to see AI come into play as those types of laborers implement it into their workflows, and maybe helping them save time or capture more margin. It's just an early stages trend I wanted to chat about today. So anyways, guys, thanks so much for tuning in. It's been a pretty long one. We'll catch up again on Friday. Take care.